Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at BlackBerry.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. For many years, the story around this company has been, well, pretty painful.
That's putting it mildly.
Yeah. A story defined by, shrinking revenue, missed opportunities, and I think most importantly, just consistent cash burn.
Right.
But the data we're seeing now suggests we are past that. We are looking at a fundamental, really critical inflection point. It's moving the company, I think, definitively into credible turnaround territory.
Okay, that is a massive statement. When people hear BlackBerry, they still think of, old phones, the ghost of past failures. When you say inflection point, what are you specifically basing that on? What's the one change that really matters?
It all centers on profitability and cost control. The management team, they successfully executed a huge and frankly painful cost right-sizing effort.
So this wasn't just like trimming the fat around the edges.
No, not at all. This was a full restructuring of the entire operating core. And the pivotal moment, the one to really focus on, that was in Q2 of fiscal year 2025.
And what happened then?
That's when the company achieved break-even adjusted EBITDA and non-GAAP EPS.
Okay, let's unpack that jargon for a second. Break-even adjusted EBITDA. What does that mean in real-world terms for, someone listening?
It means they finally stopped the bleeding.
Got it.
For years, they were losing cash just to keep the lights on. So break-even adjusted EBITDA means the revenue from their core operations is now enough to cover all those recurring operating expenses. They went from being a cash incinerator to cash neutral.
On an adjusted basis, at least.
On an adjusted basis, yes.
Right.
And that is the absolute necessary first step in any genuine corporate turnaround.
It's a huge psychological hurdle to clear, just going from negative to zero.
Yeah.
But sometimes these, adjusted figures can hide some underlying issues. Did we see this confirmed in the stricter GAAP metrics?
We did, and that's what makes this inflection so powerful. We saw the GAAP net loss improve by a pretty significant $23 million year over year in that same quarter.
Okay.
But the real confirmation came later. Sometimes a company hits break even once, a lucky contract, maybe some delayed spending, and it looks like a fluke.
Right, I was just about to ask, was this transition sustained? Or was it a one-hit wonder?
Absolutely sustained. The validation was crystal clear in the very next quarter, Q1 of fiscal year 2026. So that's the 3 months ending May 31st, 2025.
And the number?
They reported a net income of $13.3 million.
Net income. So not just stopping the bleed, but actively starting to heal the financial wound.
Exactly. It validates that the new, leaner cost structure is here to stay. And this is where that concept of operational leverage finally starts working for shareholders, not against them.
Explain that a bit more.
Well, since they right-sized all those massive fixed costs, think legacy data centers, redundant staff, underperforming divisions, now every new dollar of revenue isn't just swallowed by overhead.
A much larger chunk of it drops to the bottom line.
A huge percentage of it goes straight to profit. And that shift, it completely transforms the investment case from, a speculation on will they survive to a bet on can they grow.
That's a great way to frame it. Okay, so let's move beyond the earnings statement to the company's financial foundation. A real turnaround needs a solid balance sheet. What does this newfound cash generation mean for their assets and liabilities?
It means stabilization and strengthening. We've seen really clear signs of asset accumulation. If you track their total assets just between May and August of 2025, they increased pretty significantly.
Okay.
It jumped from, about $230.2 million up to $344.3 million. It's a huge influx of capital in a very short amount of time.
That says a lot about cash flow.
Oh.
But what about the historical baggage? They've got decades of losses weighing on the balance sheet. I'm talking about the accumulated deficit. Are they making a dent there?
They finally are. And this is a subtle, but I think critically important detail for any long-term investor. That accumulated deficit is actually narrowing.
Okay.
We saw it reduce from around $2,237 million down to $2,214 million. Now, that is still a massive number, of course.
Of course.
But the fact that the company's current operations are actively eroding that multi-billion-dollar historical loss, that's a powerful indicator. It shows they're finally generating wealth faster than they're generating loss.
So in plain terms, better cash flow means strategic flexibility. They're not operating in crisis mode anymore. What doors does this open for management? Can they start talking buybacks, or is it still all about paying down debt?
It gives them options, which is really the definition of financial health.
Mhm.
They're moving toward a sustained, positive, operating cash flow environment. This lets them prioritize. They can pay down the riskiest debt, they can signal credibility to lenders, or if the profits keep coming, yeah, they can begin considering targeted share buybacks.
So they move from managing survival to managing expansion.
Exactly, and optimizing their capital structure.
Profitability is fantastic,
hmm
but we know the ultimate failure point for most turnarounds is revenue. If revenue keeps sliding, even the leanest cost structure is eventually going to buckle. What's the revenue floor here? Is this profitability sustainable?
That is the core question, you're right. This is where we look for the magic number. So management previously guided that total quarterly revenue would be somewhere in the range of 130 to 138 million.
Yeah.
The critical takeaway is that the Q1 net income proved, I think unequivocally, that the business model works and is profitable at that scale.
So that $130 million quarterly level, that's the hurdle.
Wow.
It provides a fundamental valuation floor. As long as they hit that, they stay in the black.
Precisely. It tells the market that the entire cost structure is built around that 130 million revenue number. Anything above that dramatically boosts profitability because of the operational leverage we talked about.
Which brings us to the competition.
Right.
The software industry is brutal. We're talking giants like Microsoft, CrowdStrike, Jamf, all aggressively bundling tools. How does a company like BlackBerry maintain that stable 130 million base against them? What's their defensible moat?
Their moat is it's defensive and it's sticky.
Yep.
And it's deeply rooted in regulatory compliance. They are not trying to compete with Microsoft on, sheer breadth or the lowest price in the general market.
So where's their advantage?
It's in their deep foundation of enterprise software IP and their embedded security expertise. They're targeting highly regulated industries.
Can you give me an example of where that stickiness really matters?
Yeah, think about organizations where the cost of a failure is just astronomical. Government agencies, defense contractors, major banks, large health systems.
They aren't buying the cheapest option?
Never. They're buying the most certified and trusted security pedigree. BlackBerry holds compliance certifications, like, say, certain levels of FedRAMP authorization that take years and millions of dollars to get and to maintain.
So the moat isn't just about having the best tech everywhere. It's a barrier to entry built on institutional trust and auditability.
Exactly. It's like being the only vendor certified to provide software to, say, the Department of Defense. You might not have the flashiest interface, but you're the only one they can actually trust with the keys. The switching costs are extraordinarily high.
Right, a big bank can't just flip a switch without massive risk.
Massive audit risk, integration pain, potential regulatory fines. Their strategy is to lock down and monetize these incredibly sticky relationships. It's about retention and preventing churn, not winning every new deal in the open market.
That makes that $130 million floor seem a lot more resilient.
It is, but we have to acknowledge the risks. Every turnaround, especially one that has burned investors before, comes with significant risks. What could derail this?
Yeah, what's the bear case?
There are two core risks we're watching very closely. The first is a failure of revenue stabilization. Simple as that. If quarterly revenue drops below that critical 130 million threshold, profitability will reverse instantly.
And the leverage that was working for them starts working against them.
Aggressively against them, it would put them right back into a cash burn situation.
Okay, what's the second major risk?
Competitive displacement, specifically due to bundling. Microsoft's aggressive push with its suites is a constant existential threat. Even if BlackBerry has the best-of-breed product in a niche, CIOs are under immense pressure to consolidate vendors and save costs.
That's a very real threat. If a competitor can offer good enough security for cheap.
Or for free as part of a larger package, yeah. That squeezes margins and could push BlackBerry out over time.
So how are those risks mitigated? Is that trust factor in regulated industries strong enough to fight the cost-saving power of, say, a Microsoft E5 suite?
That's the billion-dollar question. The mitigation strategy circles right back to that defensible niche. In government and defense, they aren't competing on price. They're competing on resilience and compliance. When national security is at stake, the cost-saving argument loses a lot of weight.
And what about the valuation? If the stock is still priced like a failing company, doesn't that inherently limit some of the downside risk?
Absolutely. Because this is still a turnaround stock, it trades at a pretty low multiple. The market is still pricing in a high probability of failure. So if they prove that this profitability is sustained, the downside is relatively limited, but the upside potential for multiple expansion is huge.
That leads perfectly into the technical setup. The fundamentals look constructive. How does this translate to what an investor should be watching for next?
Well, the profitability inflection itself is a massive technical signal. When a company moves from consistent losses to positive earnings, it totally changes the pool of investors who can even own the stock.
You get the value guys, the institutional funds coming in.
Exactly. Institutional accumulation starts to build a new, higher floor under the stock price, and that 130 million revenue level reinforces that floor, technically.
So the market is essentially in a wait-and-see mode, waiting for proof this isn't a one-time thing. What's the most important upcoming catalyst we need to watch for?
The next big test is the Q2 fiscal year 2026 earnings announcement. We expect that in late September or early October of 2025, this quarter is crucial
Why this one in particular?
because it needs to confirm that the Q1 net income was the start of a real trend, not just a statistical blip.
And what are you looking for in that report specifically?
Sustained profitability, positive adjusted EBITDA, and ideally another positive non-GAAP EPS number. A profitability beat, say, if earnings come in positive when consensus was near zero, that would be the trigger for a major re-rating.
And then the analyst would follow.
You'd see a wave of upward revisions through October and November, and that's what would draw in that significant institutional buying flow.
So to summarize the whole view here, the company, once seen as a dying brand, has pivoted to become a profitable niche player, focused on highly regulated, sticky customers.
That is the core thesis. The confirmation of profitability transforms the entire perception. But this isn't an overnight thing. The value realization here is a medium-term play, probably over the next 6 to 12 months, as the market fully reprices the company based on future earnings, not past failures.
And if that profitability continues and the market does catch up, what do you see as the potential upside here?
Given the magnitude of this shift from consistently negative to consistently positive, I think the stock is positioned for a significant re-rating. The upside is strong, potentially in the range of, say, 30 to 50% from current levels, as institutional investors finally price in that sustained earnings power.
That sets a very clear strategic timeline. Keep that time frame in mind and always do your own research before making any investment decisions. If you found this analysis helpful, please remember to subscribe and like for more market insights tomorrow.